Good morning, I'm Nima and you're watching The Hot Topic. Today's hot topic is tomorrow's highly anticipated Federal Reserve meeting. Firstly, let's understand what the Fed meeting is. At least 8 times a year there's a meeting in the US comprised of 12 economists, which make up a group called the Federal Open Market Committee. At this meeting they discuss US economic policy and short-term objectives. The reason why tomorrow's meeting is making global headlines is that some analysts are expecting the US to raise their interest rates for the first time since June 2006. So, what could happen? Well, the U.S. interest rates have been at the ultra-low level of 0.25% since 2008, in a bid to help the U.S. economy recover from its longest recession since World War II. The Federal Reserve, known as the Fed, could decide to start a series of gradual rate increases, a move the markets have been speculating on the last few months. So why would the Fed consider raising interest rates now? Since the U.S. private sector has been growing for a record period, and unemployment has reduced by half since its peak of over 10% in October 2009, more jobs could lift inflation and wages. So in an attempt to keep inflation at low levels, the Fed is considering a gradual increase of interest rates or the cost to borrow money. Simply put, the thinking inside the central bank is that the U.S. economy is finally healthy enough that borrowing costs should return to more normal levels. Now the question on everyone's mind is, how could a rate increase affect the markets? If past experience is any guide, we could be in store for some serious volatility within the markets when the rate increase happens. In the short term, even a small increase of interest rates could have an immediate effect on currencies and commodities by strengthening the dollar. So we could see currency pairs like the Euro-USD taking a nosedive as dollar bulls take up their positions. At the same time, commodities priced in US dollars like oil and industrial metals like copper and silver could also weaken. Keep in mind, higher interest rates make the US dollar more attractive, particularly to foreign investors, so we could see more downward pressure on the price of gold. However, US equities like the S&P 500, NASDAQ, and Dow Jones present a far more complex picture. The rate hike has been long anticipated, so it's likely to be already priced into the markets. And historically, we have not seen a direct correlation at the beginning of a rate increase to the prices of equities. So what's next? Well, the question is not so much if, but when the Fed will raise rates. But recent turmoil in the global economy has added an extra layer of risk to the Fed's timing. The slowing Chinese economy, the slumping prices of oil, downturns in the global stock markets, and lower than expected job figures in August have all prompted questions over whether this is the best time for the Fed to increase rates. Hence, many analysts feel that they may wait until December or perhaps even March, as those are the next scheduled news conferences by Fed Chairwoman Janet Yellen. Comment below and tell us what you think the Fed will do. Once again, I'm Nima and you've been watching The Hot Topic.